in direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commons is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, you know, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. You know, they didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his, you know, oil and gas pit was described to us as amongst the top three. Amongst that, was very successful and made, you know, very large amounts of money as a young man. But, you know, inevitably, mechanisation and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commons decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, you know, drinking buddy's son, or they're his own kids' friends from football. You know, they're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, you know, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, you know, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. You know, not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, you know, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Faden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. You know, anyone that covers markets is going to be surprised about that. You know, you're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, you know, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there have been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil's going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. You know, they are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, you know, as desperation increases in the market and trading volumes go up. Now, at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, they haven't been accused of any wrongdoing. that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world. And when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it. Might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3, 4.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year, when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work. Nature Conservancy and many others see that carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
The Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is, is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single super city economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network. That in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, HART's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. Its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. Every other form of fossil fuel hydrogen, it can compete with it on price. It can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen, zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
Hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way to the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. Blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world?
Yes. That's only because we haven't had policies to support it. we had policies to support it 5, 10 years ago, it would be everywhere. You'd see the global warming budget start to come down.
Yeah.
Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line, we'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah. So for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Broker Studio in New York. Good afternoon to our worldwide audience on radio, on YouTube, and on Quick Take. It's Thursday, November 3rd. I'm Katie Greifeld. Carol Masser is on assignment today. Tim Stenovic is also on assignment. I'm told he'll be here soon, so we'll keep our fingers crossed. But before he gets here, we have both stocks and bonds under pressure after Jerome Powell's bait and switch yesterday. The bulls in retreat as traders grapple with how high the Federal Reserve's terminal rate could be. And all eyes on October's payrolls report coming in hot at 8:30 a.m. tomorrow morning. We'll discuss how high the stakes are in just a minute. And on the program today, we'll chat with Trivago's CEO about the company's third quarter earnings and the outlook for holiday travel. And we're also going to get into the turmoil ripping through the C-suite at some of the biggest cryptocurrency companies. All that and more coming up over the next 3 hours. But first, let's get over to Charlie Pellet for today's headlines.
All
Charlie.
right, thank you very much, Katie. Never on assignment. That's Charlie Pellet. We've got the Dow, the S&P, NASDAQ, all lower right now. Got to keep it locked into Bloomberg Radio to see how things shake out post-Fed. And, of course, ahead of that jobs report, as Katie mentioned, we will have complete coverage, as you have come to expect over the years. The number, as you know, drops at 8:30 a.m. We'll have analysis and reaction. The Dow, the S&P, NASDAQ, all in the red right now, with the S&P down 28, drop there of 0.8%. The Dow now lower by 107 points. That's a drop now of 0.3%. The NASDAQ Composite Index down 132, lower by 1.3%. The 10-year yield 4.12%. The 2-year 4.69%. Spot gold down $5 the ounce to $16.29, drop there of 0.4%. While West Texas Intermediate crude oil today selling off by 1.6%. 88.55 on WTI. Barrel of Brent, the global benchmark 95.03, down 1.2%. So stocks are paring losses ahead of the jobs report tomorrow, following yesterday's rout that was driven by fears that a deeper recession could be in store, with the Fed expected to hold rates at a higher level for a longer period of time to tame inflation. Veronica Clark is an economist with Citigroup Global Markets, and on Bloomberg Television this morning, she told us she has upped her forecast for peak rates.
So after the meeting yesterday, we were expecting rates to get in line with the September dots previously. So that was a 4.5 to 4.75. Now we're expecting a 50 basis point in December, 50 in February, 25 in March, and 25 in May. So that takes rates to 5.25 to 5.50.
And again, we've got the 10-year yielding 4.11, the 2-year 4.69. Big tech scaling back hiring, or actually cutting jobs. Amazon pausing, quote, new incremental hiring across its corporate workforce as the world's largest online retailer prepares to weather a slower economy. Amazon shares down 2.4%. Lyft saying it will cut 13% of staff as the ride-hailing company tries to cope with a difficult economic backdrop. This according to a memo seen by Bloomberg. Lyft shares, they are down 0.3%. The crosstown San Francisco rival Uber up right now by 1.6%. Recapping, S&P down 0.8%. That, Katie Greifeld, is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. Let's get right to the market drivers report and set the Business Week agenda with Kriti Gupta. She is Bloomberg Markets correspondent. She's here in studio with me. And Bloomberg News international economics and policy correspondent Mike McKee. He is on the phone. Mike, I know you've had a hard week, so I'm going to start with a softball here. What is the Fed's terminal rate?
You hit me with the hardest one out there. Nobody really knows. And Jay Powell made that clear. The markets have moved theirs up to somewhere around 5%, and the betting is that the Fed will end up somewhere around 5%, perhaps a little bit over it. But as Powell suggested, if the inflation rate doesn't start to fall fairly rapidly, they may have to go higher than that. So we're all going to have to kind of live with some uncertainty.
So for now, keep an eye on 5% or so?
Yes, and the Fed, if they follow the script they laid out in the dot plot, they would do another 75 basis points by the end of the year or early next year, which would put them at 475, very close to 5. So then you can start talking about, well, maybe they are getting close to the end. But for right now, keep an eye on 5.
All right, keep an eye on 5. And Kriti, let's talk about how this is being received by the market. It was pretty amazing, the S&P 500 yesterday, watching the reaction to Jerome Powell's press conference. The S&P 500 finished 2.5% lower. That is the worst Fed day reaction since January 2021. But it seems like the selling is seeing some follow through today.
Yeah, it is. What's interesting is that it almost felt like, at least in the Russell 2000, you hit positive territory very briefly. So the session, we're well off session lows, I should say. So there was this idea of a rebound trade perhaps in the works that didn't really materialize. Look, one of the bull cases for the stock market was that the terminal rate expectation of 5%, as you pointed out, was going to stall out. That was it. We were done. The pain was over. But when you are being told that, look, the terminal rate is going to be higher than what you're expecting, I mean, I'm sure the folks at the Fed are looking at what is being priced in as at 5%. They're saying, well, look, there's way more that's being expected, but we don't know how high is too high. And that's part of the problem, because because if you actually look at Fed pricing now, we went from about 5% to 5.1%, which isn't much of a change. You haven't seen the repricing. And I think further evidence of that is in the bond market, where you're just seeing all of this intraday volatility. Yields back where they started, by the way, at like 2 a.m. this morning. So it went all the way up, I think like a 12, 13 basis point intraday move, and it came right back down. And that just tells you that there's some real confusion about what is coming next. And I've heard from multiple people that maybe the markets are waiting for the jobs report, maybe it's the CPI report. What's interesting is that a lot of people are kind of throwing their hands up in the air saying we didn't really learn anything that we can actually use as of yesterday.
You know what makes me throw my hands up in the air?
Yeah.
A lot of things, but
Like you just don't
mostly the volatility index, the VIX, it's lower today. It's below 26. Is this thing broken?
Yeah, well, you know, it's interesting. A lot of people are talking about that and the risks then internally to the plumbing, because this is how market makers make their money. This is how some of the banks make their trading profits. If you're not seeing the volatility in the equity market, you're not able to make those spreads. Completely different story in the bond market, though, because the MOVE index is at extreme highs. Binky Chadha over at Deutsche Bank made the point on surveillance this morning that the 10-year yield and the MOVE index are mirroring each other. That never happens. You saw that briefly in the global financial crisis, and then never again. So that's not the sign of a healthy market. That's a sign of panic.
I don't know what to do with that. It makes me nervous, though. But Mike Creedy brought up the jobs report. And if we think about the JOLTS data we got earlier this week, if we think about the ADP print, didn't really show signs of a labor market that's starting to crack in the U.S. Do you expect more of the same in tomorrow's report?
Pretty much more of the same, somewhere around 200,000 or a little above. The consensus moved down today by about 5,000 to 195 after the ISM services report came out with its employment index showing a little bit of contraction. And services have been the big employment factory for the last several months. So we could see a slower number. Now, the Fed wants to see something around 100,000 or more, which would absorb new entrants into the labor force. But anything above that is, not the best of news. But if it's somewhere around 200,000, the Fed will be happy because of the sequential drop. They also want to see the unemployment rate to start to tick up. They predicted 4.4%. Market participants think it's going to be higher than that, but it hasn't moved at all. So they're looking for a little bit of rise in that.
Yeah, and when you think about this soft landing that the Federal Reserve is still trying to engineer, the employment market is such a huge part of it. But Creedy, we have about 30 seconds. What is the trade tomorrow? Is bad news good news, or did I get that mixed up?
No, I think we can safely say bad news is going to be bad news, and because it's quite clear that it's a lose-lose situation. If the jobs market comes in hot, the equity market doesn't get the relief that they need from the Federal Reserve. If it comes in low, well, then you've got a recession on your hands.
All right, Creedy Gupta, Bloomberg Markets correspondent, and Bloomberg News international economics and policy correspondent Mike McKee. Thank you both so much. And let's get a check on the latest world and national news. We're going to do that with Nancy Lyons in the 99.1 newsroom in Washington, D.C. Hi, Nancy.
Thanks, Katie. President Biden is imploring voters to save democracy by defeating election deniers who are running for office in the midterm elections. Biden has also warned Republicans will tamper with Social Security if they take office. But House Minority Leader Kevin McCarthy is vowing that will not happen.
Here's a commitment to America. What does it say in there? To save and strengthen Social Security and Medicare. This simply means is we're not touching it.
McCarthy's comments are not reflected, though, by all Republicans. Senator Rick Scott, who heads the Senate Republicans campaign arm, has proposed subjecting nearly all federal spending programs to a renewal vote every 5 years, including Social Security. Well, as the travel industry prepares for the busy holiday season, advocates are looking for some help from Capitol Hill. We get more from Bloomberg's Amy Morris.
Advocates and government officials warn short staffing and long lines at airport security checkpoints will just get worse if Congress doesn't pass a bill that will boost the pay for Transportation Security Administration workers. TSA workers make about 30% less than their counterparts in other federal agencies. Administrators say that's hindered TSA recruitment and retention. They expect a wave of departures unless lawmakers loosen the purse strings and make changes to the agency's pay system. Amy Morris, Bloomberg 99.1 and 105.7 FM. FM HD2.
Former President Donald Trump is suing New York Attorney General Letitia James in Florida in an effort to stop her from imposing controls on many of his assets and from obtaining information about his finances. James, in responding to that lawsuit, says Trump is still committing fraud and trying to shield documents. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, thank you so much, Nancy Lyons. I'm Katie Greifeld in the Bloomberg Interactive Brokers studio. Tim Stenovic is somewhere upstairs, I don't know, but Kriti Gupta is still with me, and thankfully she is, because we have a lot to talk about. We were just talking about tomorrow's payrolls print, a lot of eyes on that report. And it's interesting, we've actually gotten a lot of corporate news just today. Let's start with Lyft, because the news there is that it's going to cut 13% of its staff. This, of course, as a ride-hailing company tries to cope with a difficult economic backdrop. This, according, of course, to a memo to employees that was viewed by Bloomberg. Kriti.
Yeah, and it's not alone, right? You're looking at Stripe as well, cutting about 14% of their workforce. You had, I want to say, Amazon freezing their hiring earlier in the week in their ad agency. This isn't a new concept particularly, and I would argue it's actually a reversal of what you saw maybe like a year or 2 years ago when all these tech companies had a ton of money and there was this war for talent.
Those
and they
halcyon days.
They just kind of ramped up all their hiring, so now they're kind of reversing it in a way that I think no other sector really did.
I know, and how much of this is sort of, you know, the tech sector remains to be seen. What's interesting, I feel like these stories are reminiscent to what we were talking about a few months ago. It feels like there was a wave of layoffs and hiring freezes over the summer. It didn't really trickle into, you know, the big headline figures at the payrolls level. Obviously, the Fed is trying to take some of the edge off of the labor market. It hasn't trickled through yet, but it's interesting that you bring up Amazon, because we got more news out of Amazon, actually. Just a couple of hours ago, the headline broke that the company is going to pause, quote, new incremental hiring across its corporate workforce. To your point that it's pausing hiring in the advertising business.
Yeah, and then this, once again, it tracks with what we're hearing from Alphabet, which is what we heard from Twitter, arguably, although that's a different kind of deal situation. But still, 3,700 people is not a small amount to scoff at. And we've heard it from Pinterest, we've heard it from Snapchat as well. So across the board.
Yeah, I know. And we'll see in the Twitter story. I mean, it is the gift that keeps on giving. We're going to keep an eye on all of this as the show goes on. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. The S&P 500 index has trimmed a lot of an earlier slide that at one point topped 1.5% amid gains in industrial and commodity companies. Big tech, though, is where the damage is being done today. NASDAQ Composite Index now down 1.3%. NASDAQ down 132. The NASDAQ 100 Index down 1.5%. We've got the S&P 500 Index down 27 points now, dropped there of 0.7%. To put that in context, have been down as much as 1.5%. The Dow right now down 85 points, dropped there of 0.3%. Among some of those tech names getting hit hard today, Apple down now by 3.85%. The 10-year yield 4.13%, with the 2-year yielding 4.70%. Spot gold down 0.4%, $16.28 the ounce. West Texas Intermediate crude oil lower as well, down now by 1.9%, $88.33 for a barrel of WTI. The pound slumping as the Bank of England tells investors to rein in expectations for hikes. Recapping, S&P down 27, dropped there of 0.7%. I'm Charlie Pellet. That Katie Greifeld is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. That was great. So we've been talking about job cuts, job hiring freezes, mostly related to the tech sector. I want to talk about my favorite thing in the world, which is cryptocurrencies. I am so thrilled that Vildana Heinrich is in the studio with me. She is a cross-asset reporter at Bloomberg News. Vildana, great that you're here because Tim Stenovic is not yet here. I know he'll be here soon.
He's such a bad employee.
No, he's actually really great. He's just working super hard. Let's talk about a headline I see under your byline. Digital Currency Group names Murphy president, but it cuts 10% of its staff. Walk us through that. First of all, what is Digital Currency Group? Because it's pretty important.
It is pretty important. If I can just also mention, it's also under your byline. So
yeah, really a legendary combination here.
Yeah, definitely. Something you and I worked on together. But Digital Currency Group, we can sort of think about it as a conglomerate that owns a number of crypto or crypto-adjacent companies within its portfolio. So maybe some of its more popular or household names would be the lender Genesis, which we've also been writing quite a bit about recently, as well as Grayscale, which offers a Bitcoin trust. But yeah, we had this story out. It just seems like there's this big pileup of cryptocurrency companies that have been instituting either hiring freezes or have already started laying people off. I think it's one of the first places to have felt some of the bad consequences of the Federal Reserve raising rates and the market crashing and crypto prices really crashing this year, because I think there had been so much speculation and froth in that market. So you and I have this story out. They cut about 10% of their staff, and then at the same time they have this reorganization going on where they promoted their COO to a new role, as well as a bunch of other roles that have been sort of reshuffled in recent days. And it's just another one of the companies that has been, making changes as we are going through this, what we call the crypto winter.
This week alone, too. So when I think about the household names in the cryptocurrency landscape, I think of Barry Silbert, for example. He is at Digital Currency Group. I think of Sam Bankman-Fried at FTX. I think about Michael Novogratz, of course, at Galaxy. And Bloomberg News broke the story this week. 20% of the workforce.
Yeah, and I think for them, the story was that they're considering instituting the 20% cut to their workforce. I've been writing about this and sort of keeping tabs on a lot of these companies, and there have just been an immense number of changes. And it's not just, lower level analyst type positions, but also at the upper ranks of these companies. So you mentioned, for example, FTX, the CEO of FTX US, the US part or division, Brett Harrison, he had recently left. We've had changes at Celsius. We've had a lot of changes at Genesis, which we just mentioned is one of the sort of subsidiaries of DCG, Digital Currency Group. And over there, their entire lending desk basically has undergone a massive change or massive shift. So it's really happening in all corners, whether it's, these different exchanges or platforms, or whether it's lending desks or these bigger conglomerates.
And so it'd be easy to see all these headlines and say, wow, the cryptocurrency industry, maybe it's really over. But Give us an optimistic take. I mean, can I read these headlines and say, oh, the industry is just maturing now?
You can definitely read it that way. I think if you talk to anybody in crypto, as we know, within crypto, there's a never-ending font of optimism. Things are always going to be brighter in the future for cryptocurrency fans. So there's a couple of ways I think that you can think about it. One is that a lot of crypto, people who are involved in the crypto space, is they'll say, okay, we're getting rid of some of the froth and the speculation, or maybe some of these companies had overhired or gotten maybe overly enthusiastic, and now we're letting go of some of that, and what you're going to be left with is a better, stronger company, potentially.
And it's a really interesting parallel to what we're seeing in the tech sector, too. So I don't know why I'm defending crypto here, but...
I love to defend crypto. It's so fun. But well, it is a place where there's just so much happening. So it's fun and interesting to be writing about it, and also to be watching what's going on.
Well, give us the state of play on what's actually happening in the cryptocurrency market, because I mean, you and I, exactly, we've spent so much time talking about how boring Bitcoin is right now. I don't even need to check the price right now. I can tell you it's somewhere around $20,000. This isn't what...
It's $20,239.
I am so
You're
good.
Spot on.
Let me say that. I am just so good. But what is going on? I thought Bitcoin was supposed to be known for its volatility.
It is supposed to be known for that, or it has been up until the last couple of weeks. So it's been stuck, basically, at $20,000 for weeks, maybe the last month, the last 2 months or so, whereas you have a lot of people making comparisons to what's going on in the stock market, and sometimes they're looking at moves there. For example, yesterday on Fed Day, the percentage moves from top to bottom, actually for the S&P 500 was a bit greater than what we actually saw for Bitcoin. So you're seeing people make those comparisons, and they're coming to the conclusion that maybe Bitcoin is a little bit boring right now. And I think what's happening is there are just no catalysts or no positive catalysts to help spur any meaningful rally, where, a couple months ago we had an announcement between BlackRock and Coinbase, the exchange, the crypto exchange. And that even did, it was hugely exciting for crypto people, but it did nothing to help prices actually rally. So I think people are just looking at the macro backdrop with the Fed, with interest rates, all of that, and that's why we're stuck in this boring range.
A lot of headwinds, no catalysts. You heard it here first. That is Vildana Heinrich. She is a cross-asset reporter at Bloomberg News and my desk mate. It's great to see you. We look at Bitcoin right now, up 0.3%. Nothing is going on here. This is Bloomberg Business Week Radio.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenivek and Katie Greifeld. We are live in the Bloomberg Interactive Brokers studio here in New York. Katie filling in for Carol this afternoon. Carol is at the Bloomberg Growth Summit, which is a Bloomberg Live event that I just returned from. And Katie, I got to tell you, full house up there.
Mm-hmm.
I know, I was doing the panel. So.
You know, I was doing a panel.
You were doing a panel earlier.
Yeah, pretty packed.
Only saw a couple masks in the audience. And
I didn't see any.
wow, we're going to talk about preparing for the next pandemic and where we are when it comes to this one with a doctor from the Johns Hopkins Bloomberg School of Public Health in just a few minutes. First up, though, let's get an update on these markets. Say there, Charlie Pellet.
Well, hello there. Low across the board. Headline from the Bloomberg Professional Service Developing Story. We've got the headline. Jeff Bezos said to be interested in bidding on the Commanders. Again, developing story that, according to the Washington Post, Bezos interested in bidding on the football team, the Commanders. Stocks now trading mixed. The Dow just turning higher. Once again, been a choppy session today. Right now, we have got the Dow higher by 5. Little change, up less than 0.1%. S&P right now down 16, drop there of 0.4%. Nasdaq down 105, a decline there of 1%. So the Dow trading higher. S&P, Nasdaq, they are both on the minus side. The 10-year 4.10%. The 2-year yield 4.68%. Stocks have trimmed losses ahead of tomorrow morning's jobs report following yesterday's rout driven by fears that a deeper recession could be in store, with the Federal Reserve expected to hold rates at a higher level for a longer period of time. The pound is slumping as the Bank of England told investors to rein in expectations for hikes. Spot gold down $3 the ounce, down by 0.2%. West Texas Intermediate crude down 2.1%, 88.09 a barrel. ConocoPhillips, meanwhile, boosting its authorization to buy back shares by $20 billion, joining the list of oil and gas companies preparing to return more cash to investors. Shares of ConocoPhillips, they are surging today by 7.3%. Oil, as I mentioned, lower after Jay Powell, the Fed chair, said rates will go higher than earlier projected. Also, that overshadowed tightening supply with sizable output cuts from OPEC+. Konahak is head of commodities research at ED&F Man. She was interviewed this morning on surveillance.
So OPEC has shown that they're targeting a $90 per barrel level. I think if they hadn't intervened, or they will be in November, I think prices would have gone to the 70 level. Now, how quickly and how effectively they can get the discipline together and enact that cut might be effective. If they are not able to do that, then I think the recessionary implications are so severe. Yes, it would get to 70, but my base view is that OPEC will do what they can to try and really keep it at above 85.
And right now we've got crude, West Texas Intermediate, 88.10 a barrel. Brent, the global benchmark, 94.60. Oil stocks higher across the board. Case in point, ExxonMobil up 1.4%, ADRs of BP up 1%, Chevron up 1.5%, EOG Resources up 1.8%, Pioneer Natural up by 0.2%. Again, repeating an earlier headline, Jeff Bezos said to be interested in buying the Commanders. This according to the Washington Post. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. Once again, Tim Stenivek and Katie Greifeld. We're live in the Bloomberg Interactive Brokers studio in New York. Very pleased right now to be joined by Dr. Tom Inglesby, Director for the Center for Health Security at the Johns Hopkins Bloomberg School of Public Health. It is supported by Michael R. Bloomberg, the founder of Bloomberg LP and Bloomberg Philanthropies. Dr. Inglesby joins us on the phone from Baltimore. Doctor, good to have you back with us. As I mentioned just a few moments ago, Katie and I both moderated panels from the Bloomberg Growth Summit, Bloomberg Live event here. And I got to tell you, it feels like we are back to totally normal pre-pandemic activities, full room, couple masks, but not by the majority or anything. And you were able to join virtually, but there are people here in person. Are we out of this pandemic?
Well, hi, Tim and Katie. Thanks so much for having me. We are not out of the pandemic. Things are obviously much better than they were a year ago or even 6 months ago. But if you look at the numbers every day, there still are 350 people on average dying from COVID every day in the United States. And, the majority of people who are getting serious COVID infection are unvaccinated or have some kind of underlying immune suppression. But there are people who are vaccinated and are still getting very serious COVID infections. And so it's important for people to know it's far, far better than it was, but it's fairly steady. We are still in a pretty steady state of 350 people having a fatal infection from COVID every day. If you look at the stats across the country, it's still, for adults, something like the 6th or 7th leading cause of death in the United States. So it's nothing to be kind of trifled with. It's still a very serious illness.
And so, I mean, is that just going to be sort of the new normal going forward? And to your point that there's still unvaccinated people in this country, at this point, is it safe to say if you haven't gotten a vaccine by now, you're probably not going to go get the jab?
Well, I hope that's not the case. I think, the more that we learn about the vaccine, the more that information is published about it, the more the doctors and nurses who take care of people in communities keep talking about the value of vaccine. I am hopeful that more people will get vaccinated. You're right. Only about 2/3 of the country have gotten their first 2 shots of vaccine. And so the other third of the country is walking around pretty vulnerable or very vulnerable to a COVID infection and maybe a very serious one or even a fatal one. So hopefully with time, as people see that the vaccine has been really well tolerated, that major side effects have not occurred, that more people will decide to get vaccinated. It is not too late. Some people may think I've missed the window. You haven't missed the window. You could get vaccinated today. It's free in places around the country. And so I really would encourage people to do that.
Okay, so in the last minute and a half that we have with you, Dr. Inglesby, give us some lessons that we've learned over the past 2.5 years that could help us deal with future viral outbreaks. And I got to tell you, there are other my son had RSV last week. We know kids in the hospital with RSV. There's hand, foot, and mouth going around at daycare. Like, there are other viruses out there.
Oh, you're absolutely right. I think we're entering a wintertime where we're going to have continued COVID infection. We're going to have probably a pretty serious flu season and a lot of RSV, like your son. I think, one of the lessons is that we have tools to fight these viruses. For many of them, I think RSV, unfortunately, we don't have the same tools we have for flu and for COVID. But research and development in America matters a lot. We can actually still make a lot of progress against these viruses. Wearing a mask makes a big difference. It lowers your chance of getting infected. So if you're vulnerable to one of these infections, then that kind of intervention or that kind of removing yourself from infection is important. And getting tested also is really useful because it then leads to the potential for treatment. So we have now rapid tests available around the country for COVID, really easy to get flu tests as well. And getting those tests helps make a diagnosis and then can lead to rapid treatment, and that can make a big difference for people.
Dr. Tom Inglesby, Director of the Center for Health Security at the Johns Hopkins Bloomberg School of Public Health. Dr. Inglesby, good to have you with us here on a Bloomberg Business Week Radio. The Bloomberg School of Public Health that is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Let's now go to Washington, D.C. for world and national news. Standing by, we've got Nancy Lyons. Hey, Nance.
Thanks, Tim. Donald Trump's former senior counselor, Kellyanne Conway, says she expects the ex-president to announce a widely anticipated comeback bid for the White House very soon.
Donald Trump feels, I did it the first time, I can do it again. And if he runs a binary choice election, he certainly can prevail. If he just reminds you of life under President Trump and life under President Biden and sticks to those binary contrasts.
Conway says she advised her former boss to delay launching another run until after the midterm elections as to not distract from Republican efforts to take control of Congress. As for those midterms, there may be a new sign of Russian interference. Nathan Hager explains.
The Internet Research Agency, the same Russian-affiliated group accused of meddling in prior elections, is using political cartoons to promote right-wing conspiracy theories. That's according to research shared exclusively with Bloomberg News by the social media analysis firm Graphica. One cartoon claims Democrat Tim Ryan would release drug traffickers from prison in Ohio. Another shows Georgia Senator Raphael Warnock threatening people who don't support Black Lives Matter. The cartoons are signed by someone named Schmitz. Graphica says it's unclear whether that's a real artist or a made-up persona. In Washington, I'm Nathan Hager, Bloomberg Radio.
Today, President Biden said some 16 million applications for student debt relief will be approved. Almost 26 million people have applied for up to $20,000 in debt forgiveness since the White House launched the student loan forgiveness application. October 17th. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stenivek and Katie Greifeld were live in the Bloomberg Interactive Brokers studio in New York. It's election time, Katie. We got the midterms coming up on Tuesday. Have you voted?
No,
Not yet?
not yet.
Okay.
I know you have.
I did. I voted early because I'm going to be gone next week.
I know. I'm actually really surprised, first of all, that they let you take vacations. Also, that you're missing the midterms. I feel like you would love to cover it.
Yeah. You know, we didn't even think about that when we were planning our vacation.
That's good. That's healthy.
Yeah,
I like
it's
that.
healthy. Hey, well, speaking of midterms, there's also a presidential election coming up in 2024. Yes, we are already talking about that because among the most read on the Bloomberg terminal this afternoon is a piece by our own Christian Hall about how Kellyanne Conway, former advisor to President Trump, expects Trump announcements soon when it comes to running in 2024.
So Conway, of course, she was the first woman to steer a winning presidential campaign with Trump's surprise 2016 victory. She said that she advised Trump to delay launching another run until after the midterm elections, of course, as to not distract from Republican efforts to take control of Congress, which, of course, Tim, Trump has been very active in.
Yeah, he has, but at the same time, a lot of questions remain about what he has planned for 2024 and what that would look like for the Republican Party because, you know, there are whispers about Ron DeSantis potentially throwing his hat in the ring, and if the former president decides to do that, what does it mean for people who have expressed interest as well?
And so, of course, he hasn't formally announced anything, but he has teased for months that he plans to make another White House run. He's routinely told supporters that they will be very happy with his decision, and he sent a pretty strong signal in recent weeks. He said at a rally in Texas on October 22nd that, quote, "I will probably have to do it again." So pretty clear there.
As I mentioned, though, he could face a crowded field, other Republicans, including Ron DeSantis of Florida. And then there's also former Vice President Mike Pence.
I remember him.
He was vice president with President Trump. He's taken veiled shots at Trump in recent speeches following their acrimonious split back on January 6, 2021, when a crowd of Trump supporters rioted at the U.S. Capitol chanting, "Hang Mike Pence." Check out this story and more on the Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Dow Jones Industrial Average, little change, down just 6 points now, down less than 0.1%. The S&P, NASDAQ, both in the red. The U.S. 2 to 10-year yield curve inversion reaches a new extreme. Right now, looking at the 10-year yield, 4.12%, with a 2-year yielding 4.69%. Again, the Dow, the S&P, and NASDAQ all in the red. Spot gold down 0.2%, $16.31 the ounce, while West Texas Intermediate crude oil down 2%, $88.20 a barrel. Tech stocks being hit hard today. We've got the NASDAQ 100 index down 1.3%, and Apple shares, they are trading lower as well today. Apple now down by 3.5%. Stocks have trimmed losses ahead of tomorrow morning's jobs report following yesterday's rout after the Fed decision and perhaps more importantly, that Fed news conference. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. Well, the new issue of Bloomberg Business Week is out now. The cover story, shocks to the system. Yes, the global economy is in a fragile state, but here's a practical way to think about the risks. It's all about the new economy as well. We got with us this afternoon Christina Lindblad. She's Global Economics Editor for Bloomberg Business Week. She's with us right now in the Bloomberg Interactive Brokers studio. Christina, before we get into specific stories, just give us an overview of the new economy issue. And, you know, it, of course, is associated with Bloomberg's New Economy Forum. But what was the goal here in putting this together?
One of the things when we started is we were looking at sort of where we were last year when we were putting this together, and we were feeling quite hopeful 2 years after COVID that the scars were starting to heal.
Right, 2020 was not great.
Yeah.
2021 was a lot better.
Yeah.
2022 has been kind of brutal.
And then, well, you know, we were in the grips of a crazy virus, and then all these other things started happening. More crazy people are back on the horizon now, on the stage, rather. Yeah, so I think part of the story, one of the stories that we did is this, that now geopolitics are back as a risk. You know, which we hadn't, you know, we had biological risks for like a year or two, right? And that, you know, and it's not like the pandemic's gone away. So it's basically risk on top of risk on top of risk. And then we thought, wow, the world feels so fragile right now.
It does feel fragile.
Doesn't it?
It
All
does.
the talk about recession and...
Well, to your point that we've had biological risks, it feels like the pandemic has been so all-consuming over the past 2.5 years. But I like the framing of this story because you bring up Brexit, the U.S.-China trade war. Haven't thought about that in a while.
Yeah.
Russia's invasion of Ukraine. To your point that the world is very fragile right now. I mean, what's next? Help me.
Well, it's actually hard to feel very hopeful right now about 2023. I mean, I think the best that we can hope for is that, you know, there's resilience, that countries will get through what, and undoubtedly Europe will soon be in recession. Russia already is. In the U.S., of course, Bloomberg Economics expects it in 2023. But I think that, in a way, some of the things we thought were going great, like last year, which was the resilience of the labor market in the U.S., has turned to have a huge downside, right, in terms of fighting inflation. So it's like you can't even count like your, you know, give thanks for some of these things before you realize that, oh no, you know, some of these things are actually weaknesses.
Well, of 2020, we learned about how intertwined the world is when it comes to supply chains, specifically when it comes to China. I think 2022 has been about our reliance on oil in a different way with Russia's invasion of Ukraine. When we think about the countries that, I don't want to say calling the shots in 2022, but to look forward to 2023, what are the countries we need to watch?
I think U.S. and China are still big protagonists. Of course, they're pulling apart from each other, and that has consequences for many, many countries. Countries that are going to potentially be forced to choose on which side, you know, they're on. Maybe not yet, but like in subtle ways, right?
Mm-hmm.
Well, Saudi Arabia, we saw recently, the people you count on as friends in the U.S. may not always be there for you in terms of, what's happening in energy markets. I mean, if you think about it now, countries have to look at their own well-being. What Saudi Arabia is doing in terms of oil, it's like, you're talking about a country that has one giant pile of this commodity, and which in 20 years may not be in demand much anymore, right? So they're maximizing their benefits. So in a way, it's like what we're going to be seeing next year, with a background of a recession, is people are going to be looking to maximize their own well-being, and countries are, right? And so that is going to cause further strains. And you have new governments in some places, in the UK, in Brazil, and they
a new government in the UK.
Or you could say though that he probably knows more about the inner workings of what's happening in that country right now. And they're going to be making choices. I mean, domestic politics are going to be, foremost. Although interestingly, in the U.S., there's been a tradition that lame duck presidents tend to focus very much on international agenda. So we'll see what we see. If there's something that Biden.
Wait, he's already a lame duck president? We don't know.
You heard it here first.
We don't know.
Well,
we'll find out.
You're right.
Watch this space.
Rewind.
I want to talk more about China, though, because the idea that the U.S. and China are pulling apart what falls in the void and who, which countries go along with either side. If the U.S. and China are pulling apart, is that inherently inflationary?
Oh, that's a good question.
Thank you. Because you think about globalization, I mean, the thing you always hear is that it's been deflationary. You've gotten lower prices as technology and trade just continues to flow. So I don't know, is the complete opposite of that a deglobalization? Is that I don't know. Does the logic follow that that's inflationary?
Well, I mean, one of the reasons we are seeing some manufacturing coming back to the U.S. isn't because, American policymakers have been standing on the shores, calling companies to come back. It's because shipping costs got to be so high, and supply chains headaches, So some companies believe they can actually manufacture closer to their main market at a low cost. So if that is the case, then it shouldn't necessarily be inflationary that these countries are pulling apart. The thing about this, what we're seeing right now, though, is there's so many different factors also involved in those calculations, right? Because the strength of the dollar, people have said, oh, the U.S. is exporting inflation to other countries through that conduit. And if you think about, for example, the fact that global commodities tend to be priced in dollars, what it is like for a country that is a net importer of oil to be having to pay for that commodity now in which is much more expensive, then you can understand that we've seen all sorts of traditional kind of those calculuses, not a good word, are constantly shifting, and they've been shifting in the last year. I mean, from a business perspective, I think companies have seen the downside of how heavily they came to rely on one country for manufacturing, and I think that on the margin, when a company thinks now, maybe not where am I going to move that plant out of China, but where am I going to put the second or third plant? And those are good conversations to be having.
Okay, 20 seconds left. There are a lot of stories in here that I want to get to. We have time for one more. Birth control in developing countries. Why do we need to focus on sort of an old school method? 20 seconds.
Well, I think it's Africa in particular, because there is this thing called the demographic transition, and if you mismanage it, you get poorer before, you miss out on prosperity.
All right, Christina Lindblad, Global Economics Editor for Bloomberg Business Week, with us in the Bloomberg Interactive Brokers studio. Check out the current issue of Bloomberg Business Week. It's online, it's on newsstands now, and of course, it's also on the Bloomberg Terminal. It's the new economy issue of Bloomberg Business Week. This is Bloomberg Radio.
the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. We are about 60 minutes left in your trading session. Caroline Hyde, Romain Bostick, Taylor Riggs, joined now by our colleagues Tim Stedovic, Katie Greifeld in for Carol Massa, and we together welcome in our cross-platform audiences, whether you're on TV, radio, YouTube, or Quick Take, you are digesting a moon music that turns sour, a worry about higher for longer. Tim?
Yeah, that's certainly the question that investors are grappling with after what we heard from the Bank of England today and the Fed yesterday. I'm always looking for underperformance or overperformance. We're seeing underperformance today when it comes to payment processing stocks. Fidelity National Information Service shares just plunging today, down by 26%. And it's taking some more payment processors down with it. Affirm Holdings down 3%, or I should say, fintech companies and financial services companies like Affirm Holdings. PayPal down 2.7%. We got Block down 0.7%. Fidelity National Information Services reported worse than expected third quarter results and a lower full year outlook for both revenue and earnings.
And that benchmarks quickly, Katie, because we are seeing volumes just elevated slightly on the S&P, but we're down by 0.4%, off by 15 points. We're off of our lows. We're down, though, by more than a percentage point on the NASDAQ. So big tech, once again, feels the most pain, and volumes are more elevated there. We're seeing a Russell 2000, though, that is basically flat. We're off by less than a point. And in fact, a Dow that turns 26 points to the green. Taylor.
Taking a look at an S&P, though, Caroline, that underneath the surface looks 50-50, but you clearly see the tilt here to the downside. Energy, industrials, materials, the clear cyclical winners. That story continues today. You're up 1.5 to 2.5% on the day. Down, though, at the bottom of the screen is the bigger story. It's communication services and it's technology, and those are both off more than 2%, and that's where the market, Romain, has come under pressure.
Yeah, and the big drag there has to do with Apple here, down a couple of percent here just on the day alone. Now down 3% here on the day. And we should point out, just over the last 4 days, that's roughly about an 11% drop that we've seen for Apple, and actually seen similar declines on a weekly basis over the last 4 days by some of the other big tech companies. So keep an eye on that space. To the flip side, though, you have a smaller company like Etsy, which showed a lot of resilience in their earnings report that we got yesterday. Some sense that there is still, I guess, a platform out there for folks who are looking for a different type of buying experience. Those shares up about 15% here on the day. Going to get a lot of earnings after the bell later tonight, including from Starbucks. And keep an eye on Lincoln Financial. We don't pay a whole lot of attention to the insurance companies here. Down 33% here on the day, biggest one-day decline going back to 2009. They were expected to post profit on an adjusted EPS basis of $1.64. They posted a loss of $10.23. That is a big miss, one that I have never seen in quite some time.
Huge misses, and meanwhile, a market on a macro perspective that tries to swallow where ultimately the Federal Reserve ends. What is factored in terms of a so-called terminal rate? What does that mean for an inverted yield curve that goes more than 55, 56 basis points in the negative? For a radio audience, I'm looking at an upper terminal rate now, well excess of 5%. So there is a repricing going on here for the longer term, Tim.
So what about the path of rate hikes when it comes to our friends in the UK? Well, the Bank of England delivering its biggest interest rate increase in 33 years today, though strongly pushing back against market expectations for the scale of future increases, warning that following that path would induce a 2-year recession. Check out what Bank of England Governor Andrew Bailey said to our own Francine Lacroix about the path of future rate hikes.
Well, the fact that we've done 75 today, nobody should read into it that's the new norm. I don't think people would be surprised when they see that we and the Fed are looking at things through slightly different lenses.
All right, well, there you have it. Bank of England Governor Andrew Bailey speaking to our own Francine Lacroix a little earlier today about the path of future rate hikes. But Katie, perhaps no surprise, even though many different countries and regions are struggling with high inflation, Governor Bailey there saying that, of course, they're approaching things differently.
Can I just say the Bank of England has been so interesting this week? You
We're
got
always
that rate
interesting,
hike.
Brits.
Always interesting, particularly interesting this week. They sold 750 million pounds worth of government bonds, actually quantitative tightening. We haven't seen that from any other developed market central bank.
IRLQT.
There
Yeah.
you go.
I know.
A lot of letters.
How many have we sold here in the U.S.? Didn't QT start here?
But it's a passive thing. We're not like really selling.
I gotcha.
Not like extraordinary blow-up that we saw weeks ago in the bond market in the UK, and the fact that they're now managing to move to that stance of quantitative tightening just shows the power and actually what they invoked in terms of people's buying it once again, understanding and having trust within the Bank of England.
That's quite the chart there for our TV audience that you're looking at right now. Volatility,
That's less than a month.
the sixth
That's
largest
less than a
economy in the world. They really can't keep it together. But in all seriousness, I do want to go back to some of the comments that Bailey did make about the idea that by continuing the tightening at that pace will lead to a 2-year recession. That caught me off guard because how does he know that? 2, the forecasting mechanisms that they've had in the past have repeatedly been wrong. So I am curious as to how they sort of arrive at that idea that additional rate hikes would add that much stress to the economy.
And to that point, we've been having a lot of conversations bringing it back here to the U.S. You try to do these big jumbo moves and caveat it with, we don't want to make these the new normal because we're looking at the economy, we're looking at the recession on the horizon. And then when inflation is 8, 9, 10%, you're doing 4 75 basis point moves in a row. So you've had a lot of central bankers come out and try to talk it down, and then they find themselves after the data comes out that they have to continue these big moves.
Okay, I know we're awaiting jobs data tomorrow, and we got a little bit today, but I can't help but really focus on what we are seeing from tech companies, whether it's a hiring freeze at Amazon, Lyft laying off more than 10% of its workforce. We see Stripe cutting headcount by 14%. I mean, it feels like we're starting to see, the effects of rate hikes to a certain extent, but are we going to actually see that play out when it comes to the macro view of numbers tomorrow?
The tightening of financial conditions, if you will, what it actually looks like in the economy. But the question, of course, is how much of this is just because the tech sector in particular went on such a hiring spree over the last 2.5 years or so, sort of pulling that forward. I don't know. I guess we'll continue to find that out.
Well, we're definitely not going to see it tomorrow. I mean, these are still, for a lot of these companies, still announcements rather than actual action. So it'll take some time. And we were talking about this a little bit earlier on the television program about how many of these job cuts are sort of, whether they're confined to the tech sector or the broader tech sector, if you will. You're not really seeing these types of announcements necessarily from retail, from manufacturing, from even in the material space, and of course not in energy. So I think until we see it there, maybe the impact on the broader aggregate data might be a little bit minimized, if you will.
When you're still adding jobs, there's people who are losing them or indeed not getting rehired, are able to find roles elsewhere. People who work at Lyft, people who work at Stripe, some of the most incredibly successful startups either leave to go and start up their own, but notably probably have a skill set that is snapped up pretty swiftly.
Well, you hope so.
That's what we've heard repeatedly from people who we've had on the program, is the people in tech who do lose jobs are able to find jobs quickly after they lose them.
But can you find one with a day of rest, Tim? That's really the question.
I couldn't hear what you said.
Yeah. It doesn't matter.
All right, I'll go back.
It's value add, but
I'm being told to ignore you.
I think Katie
heard
it, so
that is going to do it for our cross-platform coverage. Don't worry, we're going to be back.
Are you coming back?
An hour. Oh, I'll be back.
I'll
Katie,
be coming in rest.
We're available on Bloomberg TV, on
Make sure you hit that time
radio,
going out,
and on YouTube.
You're listening to Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Katie Greifeld. We're live in the Bloomberg Interactive Brokers studio. What did Romaine say to me? I actually didn't hear him.
We got to get a transcript. I don't know what he said to you.
There's a way to do that on the terminal.
It was probably really
We'll go back and look at the
friendly and
transcript.
collegial, though.
Definitely. Hey, I do want to go back to what we were talking about when it comes to some of these high-profile tech companies that are laying people off. I think you make a really good point that hiring during the pandemic was at such a frenzied pace that we're seeing a lot of these companies come back to earth. It happened a lot in the first half of the year, and it seems like just in the last couple of days, given the news from Amazon, given the news from Stripe and from Lyft as well, that it's starting to pick up speed again. But I go back to what analysts have told us in the past, which is these tech workers are able to find other jobs pretty quickly.
It is an interesting conversation. It's one I had with Kriti Gupta about, an hour ago, because you weren't here.
Oh yeah, I wasn't here. I actually didn't get to hear that interview, so you'll have to fill me in. I'll go look at the transcript, Katie.
I mean, you went over the highlights or so, but it is an interesting conversation in the same way that, a lot of these tech companies are sort of victims of their own success that they had during the pandemic. Overhiring, sort of part of that.
That's a good point. All right, more on that in the next 2 hours. First, though, let's get an update on world and national news. For that, we go to Nancy Lyons in D.C. Hey, Nance.
Thanks, Tim. Just days before the midterms, there are escalating concerns about election security and potential threats to the process. Michael Waldman is president of New York University's Brennan Center for Justice.
We've never had a political movement led by a former president denying the legitimacy of our elections, claiming in effect that American democracy is rigged and a fraud, despite all the evidence. despite the strong evidence that our elections are very safe, very secure, and very accurate.
Waldman says elections officials all over the country are fearful about doing their job. Yet another challenge those election officials are facing is the growing barrage of online disinformation. They say there's so much they can't keep up with it all.
Foreign adversaries like China are making a final push to discourage voting and undermine trust in the U.S. election through social media posts. The head of the Cybersecurity and Infrastructure Security Agency, Jen Easterly, tells Bloomberg that threats from foreign actors are a significant concern, but that much of the responsibility falls on local election administrators. And while some of them do have local rumor control websites, those cannot compete with the flood of disinformation on Facebook, Twitter, or YouTube. In Washington, I'm Amy Morris, Bloomberg Radio.
North Korea is firing more missiles over the Sea of Japan. Japanese officials say North Korea launched several missiles today, including a possible intercontinental ballistic missile. ICBMs are designed to carry a nuclear warhead across long distances. The launches come a day after the North fired 23 missiles to protest ongoing U.S.-South Korean military drills. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much for that update, Nancy Lyons. Did you talk about Elon Musk while I was gone?
You know, we didn't, and I'm starting to feel a little bit itchy because it's been over an hour, Tim.
Don't worry, Katie. We got a Musk update here.
Oh, thank goodness.
Okay, so this one coming last night, but were you awake when this hit?
I wasn't.
Oh, you weren't? Okay, I was. That's a bad sign. This one came in late last night when our own Ed Ludlow and Kurt Wagner reported that Elon Musk, of course, now the owner of Twitter, is planning to eliminate half of Twitter jobs to cut costs. You might recall a Washington Post piece just a couple weeks ago that said up to 75% of employees there could lose their jobs, so we're starting to get more insight into that. In translation in numbers, 3,700 jobs at the company. This is a bid to drive down costs following his $44 billion acquisition. This according to people with knowledge of the matter.
Can someone stop Ed Ludlow? He breaks so much news. It makes the rest of us look bad. This is some more news that Ed Ludlow broke about Twitter. Today, Elon Musk has removed, quote, days of rest from Twitter's staff's calendars.
Hold on a
According
second.
to people familiar with the matter. Are those just weekends? What are those?
I thought days of rest were Saturday and Sunday.
Well, the monthly company-wide day off was introduced during the pandemic period. Its expiration is another sign of Musk's impatience with Twitter's existing work culture. I don't know. Who is still working at Twitter? If you were working at Twitter, would you be nervous right now?
I absolutely would be. Yeah. But you know, Ed has done a lot of reporting, and so has Kurt Wagner, about what's happened at Twitter ahead of this, because this has been an agonizing months-long process, as you may know from covering this too, Katie.
Yes.
And there was a lot of internal concern, and there was reporting early on about people who had left jobs to go work at Twitter, and then, you know, this was announced, and then those job offers were rescinded, and there was a hiring freeze. So people knew this was coming.
Yeah. Yeah, I will say it's going to be interesting to see how this shakes out, because Musk also plans to cancel Twitter's remote work policy and have staff that are spared from deep layoffs return to the offices full time.
Okay, if the labor market is getting softer and we're starting to see the economy go into recession, or there are concerns about that, then I think we're going to see these types of moves from a lot of different companies.
I don't know. Watch this space.
All right, watch this space. And check out this story and more on the Bloomberg Terminal and at Bloomberg.com.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. The Treasury yield curve inversion reaches a 4-decade extreme. We've got the Dow higher for now, been a choppy day there. The S&P, NASDAQ, both lower, and a ton of earnings after the close of trading today. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. The Dow is trading little change, but NASDAQ is under pressure. Dow's currently down 4 points. S&P's dropped 21. Well, the NASDAQ is off by 1.2%. The U.S. 10-year yield at 4.13%. Gold is down 4. Energy is in the red. And Bitcoin is trading higher by 0.5%. Among the main 11 S&P sectors, leaders were energy, industrials, and materials. Tech and telecom led to the downside. And leaders to the upside in the Dow, Boeing, Caterpillar, and Honeywell, while Apple fell as much as 4% and led to the downside. After earnings, Qualcomm fell 6%. Under Armour rose 13%. And Etsy climbed by 15%. In other news, ConocoPhillips is buying back $20 billion in stock. And wrapping things up, Starbucks and PayPal report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney. And to hear live breaking news over your Bloomberg-type squawk, S-Q-U-A, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. Well, the hotel search platform Trivago reported earnings earlier this week. Revenue for the third quarter beat, but it was a miss when it came to the bottom line. The company reported a loss per share of 19 euro cents versus an estimate of actually an earnings of 4 euro cents. We're going to get more right now with Axel Hefer. He's the CEO of Trivago. He joins us via Zoom right now from Dusseldorf, Germany. Axel, good to have you back with us. How are you?
I'm very well. How are you?
We're doing well, thanks. Hey, let's start with earnings, and then I want to get to what you're seeing when it comes to travel demand in Europe and around the world. What happened when it came to the bottom line? Just expenses rose?
No, not at all. I mean, we had the highest adjusted EBITDA of all times, so a record. What happened is that we have quite a lot of goodwill on our balance sheet, which is coming from an acquisition, a deal years back. And with the rising interest rate environment, you basically need to do impairment tests every quarter. And the impairment has basically brought down the net income.
And was there any impact at all from the strong dollar? I feel like when you look over the third quarter earnings reporting season so far, that has been a consistent theme. Was that a factor for Trivago as well?
Not really. I mean, we are a global business, so we operate pretty much everywhere other than in China. And so currencies have an impact, but not a material impact on our numbers.
Okay, well, let's move out and talk about broader travel environment right now. As I've been talking about this throughout the program today, I did a panel for Bloomberg Live at the Bloomberg Growth Summit. Katie did as well. And I started off, I asked the CMO and Chief Digital Officer of Virgin Atlantic, the airliner based in the UK, part of Virgin Group, also 49% owned by Delta, about demand and what she's seeing. Siobhan Fitzpatrick, and she told me that they are still seeing robust demand. They're not seeing any sort of slowdown when it comes to what people want to purchase in terms of flights and traveling. And it kind of runs counter to what we've been hearing about concerns about a recession globally, Axel. What are you seeing on your platform?
Yeah, so if you just look at the third quarter, the summer was very, very strong for sure. If you now look at the fourth quarter and really at autumn and winter, the demand is very strong. Yeah? But on the other hand, what we are seeing is that there are very, very first signs, tiny signs of changing consumer behavior in Europe. And we believe that Europe will be actually hit harder than the US.
What are those tiny signs?
So what we are seeing, I mean, what you would expect in a more difficult time is that people will try to mitigate the increase in prices by somehow trading down. And there are three ways how you can trade down. One is you just reduce the length of your trip, and we've seen some very early signs of a reduction in the length of stay in Europe. The second one is that you're picking a cheaper destination, and the destination can be cheaper either because it's cheaper to get there, you can drive there rather than have to fly there, or the destination is as such cheaper. And again, we've seen some very early signs there in Europe. And the third one is that you just compare more, which is obviously for us great because that's what we offer. We help users to compare hotel prices.
So Axel, just sticking with this, because this is really interesting data that you guys have. Are you talking about this just for European customers, or is this globally?
We can't see it in Americas yet. And that also makes sense because the impact of the current crisis is much more severe in Europe. Inflation obviously has hit the Western world everywhere, but in Europe you have a lot more visibility and you have real shortage. Yeah? So there is concern that you will run out of certain basic goods over winter because there are supply shortages, and in addition you have rapidly increasing prices. So the sentiment is much worse than in the US, and that's why I would also expect for next year the recession or the cool down of the economy to be worse in Europe versus the US.
Axel, you mentioned that in Europe, what you're seeing is that people are not staying for as long. Their stays have been shortening up. And it's interesting, I mean, comparing and contrasting that with what we heard from Airbnb, who reported earlier this week as well. They give a weak forecast. There was weakness in high-end rentals, maybe people not using rentals as a place to work from home. Is it a similar read in what's going on in Europe with people shortening their stays?
I think it's very different. I mean, the mix of all the travel companies is obviously very different. The geographic mix, Europe versus the US, but also the business mix. And I think what Airbnb is referring to is really this remote working, which is in a way an upper class phenomenon. And so we don't have the same exposure and not as strong exposure as they have. But that again makes sense because you have more and more companies that move to a hybrid model, or some even return fully to the office. So that's not a surprise to me that you have less demand for fully flexible housing.
I think a lot of people, Axel, and we only have a minute left with you, and then we're going to do some news and we'll come back. A lot of people think about Trivago as a hotel search platform, but what kind of visibility do you have when it comes to flights and when it comes to car rentals?
Zero.
But you can book those services on Trivago.
No, not really. I mean, so we've run some tests where we have actually used white label solutions of other partners, but we ourselves, we only operate as an accommodation search platform.
That's interesting.
So you can find hotels.
Well, what I'm seeing, what we see here in the U.S. must be a white label version, because we can go ahead and book those here in the U.S. Hey, stick around with us. We're with Axel Hiefer. He's CEO of Trivago, the hotel search platform, joining us via Zoom from Dusseldorf, Germany. We're going to be back with him in just a few minutes. You are listening to Bloomberg Business Week, and this is Bloomberg Radio.
broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C., Bloomberg 99.1 to Boston, Bloomberg 106.1 to San Francisco, Bloomberg 960 to the country, Sirius XM Channel 119, and around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
It's Bloomberg Business Week. Tim Stenovec and Katie Greifeld. We're live in the Bloomberg Interactive Brokers Studio. In just a couple of minutes, we're going to be getting back to our interview with Axel Hefer, the CEO of the hotel search platform Trivago, joining us from Dusseldorf, Germany this afternoon. Evening for him. First up, though, let's get over to Charlie Pellet because we got less than a half hour to go, Charlie.
Indeed, and we are looking at a mixed market, at least for U.S. equities, Tim. With the Dow higher right now, the S&P, NASDAQ, they do both remain lower. The S&P down 19, drop there of 0.5%. The Dow up 10 points, gain there of less than 0.1%. NASDAQ down 121, drop there of 1.1%. 10-year 4.13%, and the 2-year today 4.70% on the 2-year. The key segment of the Treasury yield curve reaching new extremes of inversion not seen since the early 1980s when the Fed also was aggressively tightening policy. So the Dow higher, S&P, NASDAQ, they are both lower. Another month, we saw another big rate hike yesterday with the Fed increasing its benchmark rate by 75 basis points, the fourth consecutive time the central bank has done this year. Gargi Chaudhary is head of iShares investment strategy at BlackRock Financial Management. She was interviewed this morning on Surveillance.
The labor market is still very strong, but do we really want to have a Fed that is creating job losses of 2, 3, 5 million? I don't think the Fed wants that, and that's why I think eventually, even though the market will and probably can price in a lot higher than 5%, they already are, perhaps even 5.25%. I don't think they'll deliver that.
And again, we do have the 2-year at 4.70%, 10-year 4.13%. Gold down 0.2%, 16.32 the ounce. Bitcoin up 0.5, 20,273. And we've got West Texas Intermediate crude oil down 2%, 88.16 a barrel. Peloton Interactive has delivered a weaker forecast for the current quarter than Wall Street was predicting, even as management declares it is beating its own timeline for turning around the fitness company. Peloton pushing higher now, up by 6.4%. Hotel stocks briefly as we're talking travel. Marriott International reporting third quarter earnings that met expectations. As we check out the hotel stocks, Marriott down 3.9%, rival Hilton down 0.6%, and Hyatt Hotels lower now by 1.1%. Again, recapping, S&P trading lower, the Dow higher, NASDAQ lower, S&P down 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really do appreciate it. I want to get right back to Axel Hefer. He's CEO of the hotel search platform Trivago, joining us once again on Zoom from Dusseldorf, Germany. So if you are streaming on YouTube or at Bloomberg.com, you can see him there. Axel, we were talking earlier about the signs of trouble that you're starting to see in Europe. You said you're not seeing it here in the U.S. yet, but what do you expect to see? As a person running a company that operates in, pretty much every country except for China, how are you planning for 2023?
So we think that actually the absolute spend on travel will be up next year. And why is that? The prices will continue to rise. You have inflation on pretty much everything in the Western world, and we do think that will continue. But consumers will, and that's to a different degree in Europe and the US, will try to counter that increase in prices. But net, we do expect that the overall spending will be up in absolute terms.
Well, okay, overall spending, you expect to see it up, but tell us about how inflation is impacting the business now and impacting travelers now. Do you see an effect?
I mean, right now you see very little effect, to be perfectly honest. And in a way, that's more or less what we've expected. I mean, we expected a very, very strong summer, as we've seen in the last 2 years as well, even during the pandemic. Because in summer is really the time to travel where you really want to get a break and where you want to see friends and family, etc. And we've seen that to a very, very strong degree. The other thing that helped this summer is obviously that the savings rate has been very high in a lot of countries, or in most countries actually, through the pandemic. So people have saved money that they could spend on expensive travel this year. And they were just a lot of things that were promised that were pushed out that you needed to do. I don't know. Disneyland was one of our top destinations, and you can really imagine how many kids were promised that they would be taken to Disneyland in the last 2 years, and at some point in time you need to honor your promise. So that's why you can't really see it right now, other than the very first signs of it. But if you look at the world around us and the world we are currently living in, everything is getting very expensive, and the real wages in a lot of our core markets are under pressure, which means that people have to save. And so I don't think it's prudent to assume that the market will just go up with inflation. We believe that consumers will save and counter some of the inflationary pressure on travel costs.
So how are you dealing with this internally right now? At the end of last year, you had, about 800 employees, Axel. Talk to us about what you're doing inside the company to potentially plan for some sort of downturn.
Yeah, I mean, we actually took a decision that was quite tough in summer. And then in summer, we said, okay, it's very clear that we were entering more turbulent times, or we were in more turbulent times already in summer. I mean, being based in Europe, obviously we're in the middle of it. And we said what was quite clear is that inflation will be around us for the foreseeable future, and that will saving money and comparing prices for pretty much everything from milk to T-shirts to hotels will be on top of everybody's mind. So we decided to focus on our core value proposition, and we've shut down some of our more adjacent products, which basically allows us to really focus on our core and to serve our customers with a product that we think is most suitable. On the other hand, it also helped us to reduce our costs, and because of that, we do believe that we'll be able to reduce our costs 22 to 23, even though inflation will push up our expenses.
And Axel, we have a little less than a minute left with you, but of all the regions that you have visibility on, which is the closest to pre-pandemic times?
I would say pretty much all of the West, yeah. So Western Europe and Northern Americas. In this summer, people were traveling like crazy, yeah. So yeah, it was as good as it could go for a travel company.
All right, Axel Hiefer, CEO at Trivago, joining us via Zoom from Dusseldorf, Germany. Always good to chat with you, Axel, and get an idea for what's happening when it comes to the world of travel and specifically hotels and lodging. It is Bloomberg Business Week. It is 3:39 on Wall Street. Taking a look at the markets right now as we head closer to the close. The NASDAQ, the underperformer today, down more than 1.1%. The S&P 500 down close to 0.6%. The Dow Jones Industrial Average just down by close to 16 points. And it's just down fractionally, about 0.5%. Let's get to world and national news. Standing by in our 99.1 newsroom, we go to Nancy Lyons. Hey, Nance.
Thanks, Tim. South Korea's defense minister is in Washington and was at the Pentagon for periodic consultations right after North Korea launched more missiles and fired artillery into nearby waters. We get more from Bloomberg's Irv Chapman.
As a response, Defense Secretary Lloyd Austin said the joint military exercises now underway in South Korea will be extended.
We have one of the largest exercises that we've seen in recent history to ensure that we have the ability to defend the peninsula if called to do so. We're committed to that. Our commitment is ironclad, and we're also committed to deterring anyone from using a nuclear device.
North Korea is deemed ready and able to conduct nuclear tests, but South Korea has no desire to see U.S. tactical nuclear weapons deployed on its territory. In Washington, Irv Chapman, Bloomberg Radio.
The UN's Atomic Safety Agency says it has inspected 3 facilities in Ukraine at Kyiv's request after recent Russian allegations of possible dirty bomb production at those sites. It says it found no indications of undeclared nuclear activities and materials. There is an update from White House Press Secretary Karine Jean-Pierre on Brittany Griner, the WNBA star who is in a Russian prison after being convicted of drug trafficking.
The State Department just confirmed that U.S. Embassy officials in Moscow were able to visit Brittany Griner today. We are told she is doing as well as can be expected under the circumstances.
Jean-Pierre says the administration is working to resolve the current unacceptable and, quote, wrongful detentions of Griner, and as well as Paul Whelan, who is also being held. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stanivek and Katie Greifeld. We're live in the Bloomberg Interactive Brokers studio. Okay, so this is interesting, Katie.
Go on.
This morning, Peloton reported results. Saw them on the Bloomberg terminal. The stock just started crashing. And I thought to myself, wait a second. So I'm going to file this one in the back for, a decliner later when it gets to our gainers and decliners time. I go to check it out on the Bloomberg terminal. Shares are higher now.
Yeah.
What gives?
I have no idea. I am happy, though, that I'm going to be doing it as a gainer because it's really interesting. I mean, the company gave a weak forecast for the current quarter, lower than what Wall Street was predicting. Everything just looked kind of bad. The analysts on Wall Street were spooked by the company's cash burn. But to your point, the stock is comfortably higher right now. I don't have a super good reason for why. We did hear from the new CEO, Barry McCarthy. He took over in February. He said that the turnaround remains a work in progress, but he also said that the ship is turning. Maybe shareholders are seizing onto that, but what a remarkable turnaround.
Well, turnaround from the highs.
In the shares.
Okay, but a remarkable turnaround today. Okay, yeah. Okay, well, I'm going to zoom out.
Okay.
And look at where Peloton is from its highs of January 13th, 2021, when it was trading at $167 a share. It's now at $9.19 a share.